Welcome back to another episode. Today we're going to be talking about if the AI bubble has finally popped. Picture this. Imagine you're in 1995 and new companies are continuing to be created at an alarming rate. But all of them have one thing in common, and that one thing is that they have .com in the end of their name. As soon as they are released to the public, the stock price soars and continues to rise. All your friends are making money, so why don't you invest your money into some of these companies, and you do so. Continues to rise, you don't think anything of it, and you think this will continue to go up and up and up, and then one day in the 2000s, it finally pops and you lose all your money. Well, what I just explained is the .com bubble, and we could be seeing something exactly like that right now in the AI industry. Over the past week, the S&P 500 and the broader indexes have not been performing that well. And this is the first real correction and signs of severe concern that we have seen from this AI bubble concern. So over the past week, the S&P 500 is down 1.37%, and the AIQ, AI-centered ETF, is down 4.44% over the past week. See by both of these charts that there's a severe correction going on, especially for AIQ, which centers more around, AI and AI companies. This fear of the AI bubble has been rising in investors, and we are finally seeing the first correction from this emotional trading environment. Really, a lot of these swings in the market have come from news that has been released regarding AI, whatever it be, and I don't really believe that investors are trading off of fundamentals. Instead, they're trading off of emotions, and this can create a very, very risky and volatile stock market environment. Some investors are actually starting to pull out their money from the stock market and put it into money market funds, hold it in cash, or treasury securities such as treasury bills, notes, and bonds. So the first concern around this AI bubble is valuation. The S&P 500 forward price to earnings ratio is reaching levels close to the peak of the .com bubble, as we're seeing from this chart. As of October 31, JP Morgan released this, and the forward PE of the S&P 500 is sitting at 22.9 times earnings. Now, all of this can be justified if companies are producing strong future earnings per share growth, but we're really not seeing that. And this is where some of the concerns start to rise with this valuation. The 30-year average of the forward PE of the S&P 500 is 17.1 times. We're significantly above that. Every time we have reached this overvalued territory, the market usually reacts, and it reacts poorly, and it corrects, or in terms of the .com bubble, it just completely crashes. So how is this AI bubble even being created? Well, Bloomberg released this interesting graph. Really, of all these AI trades, it's been centered around Nvidia, as we can see, which Nvidia is sitting in the middle of this bubble chart. Nvidia actually just had a stellar earnings report, but investors are still extremely scared of, this AI bubble that's looming over the market. The main concern around this chart is the investments as well as the venture capital. We can see that Nvidia agrees to make this huge investment into OpenAI, and in turn they return hardware and software. Seems all good in retrospect, but the concerning part is that Nvidia can now release this investment as revenue. The market really trades off of this earnings release, so Nvidia may be producing stellar revenue, but a lot of this is coming from investment. This is technically revenue, but it creates a lot of problems as investors trade on earnings release, and this revenue isn't really revenue. So investors are pushing up the stock price when AI companies aren't really selling any products or services to justify this revenue increase or these investments. And that takes me on to my second point. Many investors are actually starting to relate this to the Industrial Revolution, and Wikipedia even created a term called the Fourth Industrial Revolution, which relates to the AI boom. During any revolution, the capital expenditures, or the amount of money that a company is investing into itself for a future return, skyrockets. And in the case of AI companies, it has been growing extremely rapid from this chart. To fund this increase in capital expenditures, many companies are taking out loans or debts to finance these expenses. But the important note is if this increase in Capex will actually pay out and companies will make their money off of these loans or bonds, whatever it be. Like I shared, many companies are producing revenue from investments, but not actually selling their products or services. So really no one has proof of whether this Capex spending will actually pay off, and there's severe risk from this. If companies aren't actually selling their products or services, something that actually creates a healthy business over the long term, not short term, then we don't know if this capex increase will actually pay off and companies will make their money off of this increase in expense. So what should you guys do with your money? By no means am I a financial advisor, and take whatever I say with a grain of salt. This is just for educational purposes. We could be in the downturn of the AI bubble. It could be popping, but really only time will tell. Maybe this is just a slight pullback and it will continue to go up. Do I think there's an AI bubble? I'm really not sure, but signs are starting to shift towards, the fact that there definitely could be an AI bubble. Or in any case, just severe risk with how these companies are, producing revenue, as well as valuation concerns and their capital expenditure investing. But if we are in an AI bubble, continue to invest in the S&P 500 and don't stop. This certainly won't be the downturn of the market. It won't go crashing all the way down, and this could just be short term. But investing in the market when it's down will certainly pay out, as you're getting the price at a discount, and continue to invest, and you're going to see, compound interest and a very, very healthy return over the next 10 years, 20 years, whatever it be. Also make sure to diversify your portfolio. This is an important lesson that we are now seeing, to not concentrate your portfolio on only a couple of equities. This can be extremely risky. Yes, it can pay out. Warren Buffett actually followed this approach towards his investment strategy. But, if you're trying to make wealth over the long term, this is not the investment strategy for you. If you were to only concentrate your portfolio on Nvidia and say AIQ, that ETF that I just discussed, your portfolio would be burning right now. So look at broader market ETFs such as the DIA and SPY, which follows the S&P 500 and the Dow Jones Industrial Average, as well as broadening your exposure in international equities. They kind of all correlate now, so, you're not diversifying too much by this, but they don't perfectly correlate. So, it's important to broaden your exposure into these international equities, as it does offer some lower risk investment assets. And any of these international equities could be any of these ETFs right here. So I hope you guys enjoyed this video. If you haven't already, definitely make sure to check out our Discord. It's in the link down below. And it's completely free, and you get all the trades I'm making in this extremely volatile market environment, as well as any stock market updates, economic news, and what I think is happening in the stock market right now. So I hope you guys enjoyed this episode. Please drop your opinions down below. Make sure to subscribe, like, and comment, and I'll see you in the next episode.